Hey Kate, how are you doing today?
I'm good, Drew. How are you?
I'm doing fantastic, man. Living the dream. Woke up above ground today, so yeah, nothing to complain about.
Man, love to hear it, boy. Yeah, I know. I know we got a lot of life things happening, a lot of life changes, and it's exciting. It's exciting to, be a
Absolutely.
part of it together.
Absolutely. And it's so easy to get sucked into the negatives and the stresses behind it. But, I think having positive lights, especially someone like you for me, I've been sharing like these financial changes and things that I've been making in my own personal life. And rather than you saying, "Oh man, that sucks, life sucks," blah blah blah. It's always good to have that positive reminder of like, no, look at it from this angle. Like, don't fall into the headspace of stress. Look at it as excitement. So I appreciate your friendship for sure for that one.
Yeah, absolutely, brother. And I'll say I'm gonna be muting myself throughout this video just because we have construction going on at my office, so it might be obnoxious. So, um, yeah. Drew, do you want to just kind of promo the meetup and then I'll hop in?
Yeah, absolutely. So super stoked about this month's meetup. We're meeting at the Arizona Sands Club as usual, 5:30 to 8:30 on the 31st of this month. So we're really cutting it close to the actual date of the end of the month, but it happens to work out that way. Stoked about it. If you guys saw last month's video, we actually brought in our featured guest speaker for this month. If you haven't had a chance to watch it, I would definitely go back. He gave us a lot of insight as to what he's going to be talking about, but didn't give all of the meat and potatoes. So it's still worth it to go to the event. But super stoked to learn from one of the best out in the game, especially in our spheres of social media marketing. Managed to turn an account from 0 subscribers to 600,000 relatively quickly. And he's averaging about 1.1 million views a month, all just showing motorcycle safety and really honestly classes on how to ride a motorcycle and things to watch out for so you prevent accidents. So it's a very unique channel, very niche channel, yet still super successful. So super stoked to hear about that because that's a feat of its own. The ability to earn that. I know Cade and I have dabbled a little bit in socials ourselves, and yeah, it's impressive.
Dude, it's extremely impressive. I like we say all the time, like if you can create a following and a brand that has that amount of subscribers, that level of commitment, like you could sell socks, bro. So it just shows the power as to what a following can actually bring to your business and to, your life, really. So that's one thing that I think Dan will be sharing and basically giving you tips on how you can create the same thing that he's been able to accomplish. So I know for all of us business owners, salespeople, that's huge in our industry. So highly recommend you guys make it out. Again, it's a free event. Like you're doing yourself a disservice by not showing up. The amount of value and connections we bring on a monthly basis is freaking mind blowing and it's free. So there's really no reason as to why you shouldn't show up. Everyone is super down to earth and willing to help each other. And I think, that's a misconception oftentimes from people getting started in this industry, in this business as a business owner or solo entrepreneur, is that they're doing it alone, right? And so when we all come together, we share ideas, we share what works, what doesn't, we hold each other accountable, and it's just an amazing community. I don't think we've had anyone that's shown up in our group that has like teared someone down who's trying to do something similar to what they're doing. It's always been collaborative. It's always talking about ideas and execution of those ideas. And so it's just great people. So, I mean, I highly recommend it. There's no reason why you shouldn't come. Drew's going to be talking about our main point of today's video. So I'm just going to briefly give a quick update for a market summary that was recorded in April 2024, according to the MLS, for our Pima County real estate market. And then I'm going to have a quick call to action. So the number of listings we had active on the market in April recorded at 3,948. We were down about 50, 60 listings from the previous month. Our absorption rate came in at 3.38 month supply, which is strong. And our days on market dropped about 4 days to 50 days average days on market. So We're getting, we are actively dropping from February month over month to this month, which is good. So my call to action is to really understand the absorption rate. I just made a YouTube video last week, I think, regarding the absorption rate and why I think it's one of the most important metrics you can understand when it comes to real estate. And I actually cross-reference our current real estate market with 2006, 2007, and 2008's real estate market, and how just using the absorption rate, you could have forecasted a major crash. And so I want to express the importance of this metric. I'm not going to discuss it here today for the sake of time, but just understand, go look it up, go watch my video. It's on this channel. The absorption rate and the month supply. It's the most important metric you can understand when figuring out, again, how are you positioned, whether you're an investor, a buyer of real estate, maybe you're looking to sell your home, maybe you're looking to accumulate more rental properties. So it just helps you understand the position that you're in, both in the real estate market and then the overall real estate market as a whole. Is it healthy? Am I making a poor decision at this time in this current real estate economy? It's an amazing metric. It needs to be talked about more. So that's it.
I love that. I love that. And to kind of, hit on that point, I think it goes to show the expertise and knowledge that Cade shares with his clients, because I don't ever hear any realtors I don't want to say that I don't ever hear any, but it's very rare that I hear realtors talk absorption rate and really discuss that metric with people. And I do think it's super important. You look back at what we've learned over time, and there's that concept in economics called opportunity cost. And I know we've referenced this on the channel before, but are you making a right decision, or is your money better spent elsewhere? And I think the absorption rate really kind of answers that question in the opportunity cost metric just by that number that you can follow. So definitely a super sophisticated, super important metric. And I would definitely, if you have questions, Cade is always up for talking and just kind of bouncing those ideas around and making sure that you're making a educated and smart decision. But yeah, I'm super stoked, and I think it's cool that the market kind of is in a way where it's headed and where it's going. I kind of like that in the real estate market, but also in the market that I tend to reference quite frequently. And so I'm kind of gonna go over that. Now, these metrics are not financial advice. I want to preface that before, so do with it as you please. But I'm just gonna talk general market here. So I know for a while I've been preaching at the uncertainty of the market. And I've been saying, I don't know what's going to happen. Who knows? But the more and more I learn, obviously, the more and more my mind's going to change. And with information and data that I've now been presented, it makes more sense that we actually kind of, I think, jumped the hurdle of the looming recession talk that we've chatted about. So, we've always been under the impression that we're going to be hitting a recession. There's going to be some point, and who knows? Metrics aren't always everything in a sense of 100% accurate, but they are pretty good indicators. And the company that I work for has been shifting their mindset from a possible recession to now leaning more towards a soft landing, where the Fed was actually kind of able to overcome what was talked about. So looking at recession numbers as a whole, the the idea that was shared was we kind of already went through the possible causes of a recession throughout the last year. Last year had terrific returns as a whole, but that was really held up by seven stocks. You hear about the Magnificent Seven, and honestly, it's even really the Fabulous Five and the Terrible Two. But the Magnificent Seven has really held up the market. And so when you're looking at the overall S&P 500, the market was down last year. What we saw was a lot of earnings cycles throughout the course of last year had bad numbers. So, Q1 of 2023, a set of stocks had bad numbers. Q2, a set of companies had bad numbers for earnings. Q3, same thing. Q4, same thing. But throughout that whole entire year, we did kind of see the fluctuation and rotation of all stocks kind of give their poor metrics. So what that's signifying as well is that there's potential for us to kind of mitigate and not go through necessarily a recession this year or even ever, at least over the next few years, because of what we saw, right? You also look at metrics like GDP, you look at metrics like unemployment, and those numbers are relatively strong. Unemployment went up a little bit this month, but in general, numbers wise, it's still relatively low and competitive because it is important to have some level of unemployment in the country. The other big metric that I've been learning a lot about was every single year that there is at some point somewhat of a pullback. We just had that pullback starting in April going into May. And so, as long as it's usually north of a 5% pullback by the end of the year, it's some high percentage amount, the economy ends at positive, if as long as we see a higher than 5% pullback throughout the year. So we did see that. Now, history isn't always indicative of future, but if we take a look at what has happened historically, it's pretty safe to say that we could potentially see a good possible return this year, double-digit return this year, by the end of the year, knowing kind of what the economy is doing. So my call to action is, what I would say is just, again, like I always kind of stress, keeping up with those financial decisions that you're making, consistently invest, have your game plan, continue doing what you're doing, what you've talked about with professionals doing. Don't change anything. Don't try to time the market. Just continue your plan and your strategies as according to what you and your professional talk to. And if you haven't spoken with a professional, please do so, whether that's myself or someone else. It's important to know what exists out there, what's available to you, and what the market might hold, because your situation might indicate one way or another, and you wouldn't know that unless you either are communicating with someone or you're knowledgeable. So my call to action.
So I guess I have one question in regards to that information. Do you think, and this is just above my head and pay grade to be honest with you, but do you think that because there's just been so much money printed, like at least in our adult lifetime, right? Or, really like since the late 2000s. It just seems like there's a common theme in like politics and whatever of just constant printing of money and inflation and all that. And so do you think that based on what you know, and if you don't, that's fine, but I think do you think that because of the printing of money, the increase of the money supply, that a lot of these returns, like positive returns, like it has to be that way because there's just been so much money printed versus like no, like these companies are actually profitable, they're actually cash flowing, therefore we have like good returns and good investment products versus no, just because there's so much freaking money just being pumped into the economy and ecosystem that as a byproduct you have to see positive increases just because there's that much money just being dumped. I don't know if that question makes sense, but can you maybe
Yeah.
talk about that?
Yeah, I mean, this is solely based upon my, just guess out there, but from my education, from my understanding, I feel like yes, in a way that's exactly that. So when you're looking at profitability and stocks, you see it in the real estate industry, you see it in the stock market, right? Companies trade on earnings. So generally speaking, the more profitable a company can be, the more earnings that they have, and earnings and profitability trigger valuation of a stock, right? So let's look at Suburban Real Estate Group, for example, right? Let's say right now you have a generating revenue of a certain amount of money, right? So let's just say you have 100 properties and you charge 10%, and each property is rented for $1,000, right? So $1,000 times 10% is $100, and you have 100, that's $10,000 a month you're charging in profit, right? Now let's say the economy in the rental market goes up, right? So the people are charging more and more for rent. You did absolutely nothing different. The same 100 properties exist. You're charging at 10% stays exactly the same. However, the amount of rental income that you're bringing in has gone up because maybe rental prices have gone up 50%. So now instead of making $100, you're making $150. And so this $150 turns into $15,000 in your pocket on a monthly basis. Companies do that exact same thing, but on a higher level. And so what's happening is that all of this inflow of cash accumulated, and what it did was it drove up products. That's what the inflation did. The inflation drove products up in pricing. So companies were charging more for their products. and consumers were continuing to buy, meaning their profitability went up. And so the economy essentially got worth more or more valuable. So if you were participating throughout that entire time, you absolutely had the opportunity to make money. Now the question was that when pullback started to happen and the government started to, or any, everyday consumers started to feel the pain and they stopped buying as much, would these companies come back down to planet Earth? Because they were on cloud nine for a while. And the answer to that question is not really. They didn't really shift all that much. Company valuations are still the same amount. I think a lot of it had to do with the fact that this money wasn't artificially printed in. It was actually printed in, and the Fed has done a good job at kind of manipulating their tools to kind of ease it. So, in a sense of, they were able to create this soft landing and in a way just say, well, we were several years behind, so this just made us up with time. Now, I did have a conversation with an individual who's a lot smarter than I am, and he was telling me a lot about the fact that the United States having the global currency plays a huge role into that, because we can manipulate the dollar because everyone else's economy is based on what we decide to do. So our dollars won't devalue as much over time. If we were in a different position where we weren't the global economy and we weren't the global currency, things would be different, and this printing of money would actually be detrimental. It would hurt us a lot more. So to answer your questions, yes, I think that the mass printing of money did allow for lots of returns, but it also allowed for things to get more expensive. So we on the consumers made a lot of money, but then it did come back to bite us in the end when things costed more money. So that's kind of the idea there.
Yeah, and then the question and concern becomes, when does this end, right? And I think that's the failed system of getting off the gold standard,
Mm-hmm.
is that once you become a fiat currency, which is, to my understanding, just currency that's not backed by gold or any, real material,
Mm-hmm.
then what happens is you could just like print money and then it's just you just out of thin air, just print money. But the problem is there's no real value attached to that, right? Because currency and value is two different things. The value behind gold, right, and like silver and these real minerals is the fact that they can be used in various ways. They could be made into jewelry. They're used in semiconductors and batteries and, all this crap, right? But there's value in that, because the value is the fact that I can take that mineral or that material, I can then manipulate it in some way and then create a product that I can then, right, trade, right, for food or housing or whatever the piss, right? And so the problem is now we don't have that. Now it's just create a dollar because I can create a dollar. And so I guess my fear, and again, this is all over my head. I have a basic understanding, I believe, but is, when does it end? Right. And
Yeah.
and at what point do we have to restart the algorithm, right, or the currency? Because you can't just keep printing money. Because at some point, right, like my understanding is this: if we print more money, that means you're increasing the money supply, which a byproduct of that becomes inflation, right? Or well, that is inflation, increasing the money supply. But the problem with that is now that just means the average person now has access to more money. Whether or not Drew Karcheski owns more money or becomes richer because the freaking Fed prints more money doesn't matter. The fact of the matter is this whole economy just has now access to more money. But who really is getting access to all that money? It's not the general public, right? It's the government, it's the bigger corporations, it's whatever. I don't really know how that all plays apart. My point is that at some point, right, these massive corporations, we were just talking about this before the call, why in the 80s and 90s were the top 10 builders in the US all private companies? Now they're all national companies, right? And public companies, because it costs too much, right? So people realize, wait a second, I can't afford to build and be profitable as a private builder. So what am I going to do? I'm going to get a bunch of people to dump cash into this, and because that's the only way it can be profitable, right? To do it at scale. And so the average person, we have more basic consumer people in the world than we have people who are ready to put a hedge fund together and go build some freaking multi-billion-dollar company, right? To service a ton of people. So my point is like at some point it's got to give, right? So like we can fluctuate, these cash flow numbers and figures and profitability, but at some point the average person does not have as does not have more money simply based on the fact that we could just print more money. They don't. The big ballers have it, right? Or the rich have it. And at
Hmm.
some point, and it's already happened, right? Like there's not really any middle class right now. It's not as common as back in like the 40s, 50s, and 60s. Um, so like at some point that's just going to dissipate. And I do believe at some point there's going to have to be a restructure in the currency, whether we get back on the gold standard or something of that nature. Because you could print money and currency all day long, but at some point it becomes invaluable because it's not really used. There's so much out there, right? Even if you are a world power, at some point, right? Like if we just kept on the system, at some point it will fail. And I think I saw an article. It's like if we stayed on the same level of inflation that we have been on from 1990 to today, I think in 20 years or in 10 years, the average cost of a home would be $9 million. So you're telling me, and like I think it was 20 years, but in 20 years, the average home, not just like a nice home, the average home in America is going to cost $9.9 million or whatever it was. Like the average person will not have that. I don't care who you are. Like what is it? Like 700 million people in the US?
No, I think it's like 350, 360
Three,
million.
so 300, let's just call it 300 million, right? Three out of 300 million people, you think the average person is gonna have $9 freaking million, right? No, dude, it doesn't matter how much money they print. Like that's just not gonna happen. So at some point, right, like we either have to get back on a standard because there's no valuable currency is just currency, it's just a tool. There has to be value attached to it to like keep it level, or they're gonna have to restructure the currency. And again, this is all speculative in the sense that I don't really know what I'm talking about. I just have a basic understanding. But what are your thoughts on that?
I mean, I think it goes back. There's several things. Like as you were saying all that, my mind was like, but like the first thing, right, is yeah, you're exactly right. I mean, kind of in a projection of like what we're doing. There's three key statistics that I've seen right now that scare the living heck out of me. So, for example, number one, Dow Jones, or excuse me, the Nasdaq, the Nas, no, what was it? That was the I'm gonna actually withhold from saying that because I don't know. But one of the major indices that we tend to track, and I can't remember which one it was. I'm blanking on it right now, but that will hit a million. So I know that the average trading pace right now is 30,000, like 32 or 33,000. So whatever index that is, and I'm blanking on it right now. But that's on pace to hit a million in the next 40 years. That is a 30 times growth in the next 40 years. That's insane, right? Because on average, when you're doing industry growth, right, you say, okay, 8 to 12%. If you're looking at an 8% return by the rule of 72, which basically you take the number of 72 and you divide it, that means that your money would double every 9 years. Well, and this is specific example, which is a healthy growth. In this specific example, they're projecting that it's going to grow 30 times over the next 40 years. So you tell me how that makes any sense at all, because to me it doesn't. Now, what I will say is, you look back and you say, okay, uh, how does this work, right? And exactly that, like things get more expensive. Well, the minimum wage is the common reflection point of what is actually happening for the lower class, right? So people who are working minimum wage jobs, can they support themselves at $15 an hour? Absolutely not. That's what our minimum wage is. And so what happens is inflation happens, things get more expensive, government says, oh my gosh, this is bad, they subsidize, then they kick up minimum wage kicks up, then companies say, oh, I can charge more now because people have more money, things get more expensive, government says, oh my goodness, I need subsidized, kick up minimum wage. It's a cycle, it's vicious, right? It keeps going and going and going. I saw a statistic, and I live in Arizona. Kate lives in Arizona as well. So any of the nationwide viewers, look it up. But if you live in Arizona right now, the average annual income to feel comfortable to support a family of four, so yourself, your spouse, and two kids, is $213,000. That's what you need to feel comfortable in the state of Arizona. That's insane, especially because when you're doing minimum wage at $15 an hour, so 15 times 40 times 52, that's 31,000. So that's for one person. So if you have two fully working parents at $15, it's actually $14.35 is minimum wage. But so $15 an hour, if you have both family members working full time, that's $60,000 a year. And you need $213,000 to feel comfortable in Arizona. That's ridiculous. So, yes, I totally think that there's a way. Now, to look at kind of the solution, the government has the Federal Reserve, and the Federal Reserve's strict, like their job is to do exactly what we're saying. And so they do it through economic expansion and contraction, and they do it through what's called quantitative easing. And so ideally, they pull different strings, and that's what tends to lead the market to react the way that it is. Now, the biggest way that they do it is they hike interest rates. What hiking interest rates does is it keeps people investing and saving because they can get high interest on their earnings, and it's too expensive for them to make major purchases or leverage their money because they don't want to spend the 7%. So there's this inverse. Now, what the government wants to do is they want to pull money out of the economy and make the economy, they want to contract the economy slowly over time by having super high interest rates for a long period of time. So people continue to put money away. They're not incentivized to buy houses. House prices then come down. Those housing prices that decline, that have come down, will then incentivize people to say, okay, maybe this good doesn't trade as much as it should, because proportionally to house prices, you shouldn't have an egg be 1% of a house price. You should have an egg be, 0.2% or whatever. Proportionally, it needs to maintain what it is to house, and home prices are usually that tangible good that we tend to lean to because we're not on the gold standard anymore. So we look at real estate, right? And so when you're kind of looking at it from that perspective, then you would say, that makes sense. We should see hiking interest rates. So over the short term, real estate prices should start to come down. But for whatever reason, in the economy that we're in, and what you and every other real estate professional that I've spoken to have said, and what metrics and numbers have shown us, is the real estate market's still super strong. And so we're in this weird place where we've got interest rates that are up here, real estate market's super strong. And I think a lot of it had to do with the shock of the amount of cash that was inserted in the economy. I don't think we've ever seen anything like this before. And so we're in uncharted territories. People are still comfortable paying right now, $500,000 for a 2-bedroom, 2-bath in Midtown Tucson, when in reality that would have been absurd. And so I don't know. I think when you're looking at it from that perspective, we don't really know what's going to happen. We know what the government's trying to do, but at this point, I think they're kind of in this sense of like, we really kind of overdid it, and now we're trying to see what's going to happen and play out, because we don't have our hands on the steering wheel anymore. We're kind of letting the car drive itself, and our job is to push the gas and the brakes and hope that we don't crash. That's kind of my view on it. And again, this is not financial advice. This is just me and my speculation based upon the research and knowledge that I have. But does that make sense?
It does make sense, and it is it's kind of terrifying, it's like where does this go? Where does it end? And so again, our call to action pretty much every week is just to, first and foremost, seek professionals. I would even argue seek, if you have any family or friends or, people who've been in whatever it is they're in for a long period of time, they've been through multiple market cycles. And ideally, we always want to think that we're like in the best cycle right now, right? We're like, oh yeah, like lending regulations, they've changed since 2008, right? We're fine. But like, yeah, but with changing lending regulations, maybe there's a factor we have yet to consider because we've never been through it, right? And so there's always, and I'm not trying to be a Debbie Downer, but I'm just saying there could always be another factor we have yet to account for, simply based on the fact we don't know what we don't know as an economy as a whole. And so it's like, okay, well, what does all this freaking printing of money really do, right? Like it may be good right now, but what does it really do? And so I would just encourage you guys, at the end of the day, all you can do is make the most amount of money you can, stay diligent with your work, right? Lean into your investments, spend wisely, live below your means. I would never encourage you taking on a huge amounts of consumer debt. Just live below your means and work hard, save your money and invest it. And at the end of the day, if you're doing those things, you're better off than 90% of people, because the average person has $100,000 student loans, $500 car payments, and they have like 6 cars, right? And then so it's just crazy out there. But if you pay things off, you live below your means, you're investing your money wisely, 10% of your income, you're going to be fine, I think, in the long run. Even if the market tanks and all that, I mean, you will be well off because you're not saturated in a bunch of crappy consumer debt, and you live below your means. So, I mean, do you have anything to add to that, Drew?
Oh, I think you said it to perfection. Just be, again, yeah, checking out with your family. I think we say this all the time, but only listen to people who are in the position that you want to be in. That's why, going to networking events like ours and just meeting the people who are potentially in the position that you want to be in is super invaluable. And growing ideas and growing your relationships with these people, because you never know when you can lean on them eventually down the road.
Drew, did you have a quote to end us off?
I did not actually,
That's
but
fine.
I can
I have one that just came to mind, if you don't mind.
go for
Um,
it.
it's one I shared a couple weeks ago now, but I keep thinking about it, and it's the most expensive thing you can own is a closed mind. And that's just been sitting with me for a couple of weeks because there's so many ways that people live this life on this, thing we call Earth, right? And so for you not to keep an open mind when meeting with people, and we're business focused because that's our group, but I'm talking about anything, right? Maybe it's your health, maybe it's your spirituality, maybe it's your family, right? Maybe it's traveling, whatever it is, keep an open mind, because you could cost yourself of great things simply just by being closed-minded and not being open to the idea of change, or maybe what you think isn't actually true, right? And so what's the harm in that? If anything, you prove yourself right. So keep an open mind, right? Um,
Mhm.
so I would just encourage everyone, keep an open mind moving throughout this week. And for, the rest of the year here, just keep an open mind to different ideas, and, try to learn it for yourself. Worst case scenario, you just stay the same position you are now. Best case scenario, you change and adapt and your life is better. So why not keep an open mind?
Absolutely. Absolutely. Awesome, Cade. Well, thank you so much for your time. I feel like it was a very educational episode, and I'm really excited. Again, quick rundown: May 31st, 5:30 to 8:30, Arizona Sands Club. Link will be all of the information will be in the description below. And reach out to Cade or I if you have any questions or any want to know anything about the meetup. We're more than happy to answer.
Thanks, Drew.
Thank you.